Hi, greetings everyone. So this is the second lecture of chapter number 14, choosing an appropriate investment strategy. In the first one, we did cover institutional investment objectives, risk for institutional investors. We defined what the risk is. We also saw how the risk appetite is being set by institutional investors. And we are halfway through section number 3, which is the factors influencing in institutional investment strategy. So we are done with this slide and we will move on to the next. Okay. So with this, I hope you remember the whole number of factors in this case and hope there is no, confusion or, hope there is clarity amongst all this. I guess these are somewhat around 15 to 18 factors. So hope there is clarity with regards to the same. So now we will look at some of the four factors in a little bit more detail. Kind of just liabilities. There is this one point for the liabilities that you will need to hold additional buffer in case the liabilities are uncertain. So main example we can see in case of a general insurance company. So for general insurance company, the frequency of the claims can be anything. It can be an unknown number and even the claim severity can be an unknown number, right? So in this case, liabilities are very uncertain. The frequency is also uncertain, the severity is uncertain, and the liabilities might come. All liabilities are short term, so they might be coming to you. The liabilities might occur within a span of 1 year, right? So it's because of this high uncertainty, general insurance companies would be requiring very high liquidity buffers and very high investment in liquid assets so that they can meet these liabilities whenever they occur. Um, Something more about the liabilities is what we saw out here in this part. Nature of existing liabilities, currency, term, level of uncertainty, and future accruals. So all this is also important while considering each of the liabilities. Moving on to diversification. Again, there was a point there, but we are just expanding it a little bit more. Large institutions, while investing in an asset, so okay, they have a portfolio A. They have a portfolio A. They are now planning to add asset X to it. Okay, so adding the asset X on the overall portfolio A needs to be assessed. So what impact would it have on the portfolio? Will it make the portfolio more risky, more less risky? Is it a diversification, or are we just simply increasing our exposure in a particular industry or in a particular segment? So all those things need to be assessed before looking forward, before trying to go and invest in this asset X. So all these things are looked at by the company, and accordingly, its impact is being computed or obtained. So covariance of the asset return with rest of the portfolio is important. So when we look at statistical relationship, the first thing that comes to our mind is correlation and covariance, right? So if the whole portfolio returns, the returns of the whole portfolio have correlated, or what is the covariance between the returns of the portfolio and the returns on asset X. So if correlation is kind of close to 1, in that case, what does this mean is that basically it's the same portfolio, it's the same thing that you are investing, and you are not diversifying your portfolio, right? You are just increasing the exposure of the same components by adding asset X. So that won't be approved probably. And if the correlation and covariance are basically lesser, close to zero, or if it is -1, then it would mean that you are adding the asset as a hedge or to the rest of the portfolio, because if the rest of the portfolio goes up, this asset will go down, and if the rest of the portfolio will go down, this asset will go up. So yeah, this covariance and correlations are being computed before adding any asset to the existing portfolio, so that diversification is important. The best diversification will happen only when um, both are completely uncorrelated. The covariance and the correlation basically is zero, which would mean that even the covariance is also close to zero. And when the covariance and correlation are close to zero, we don't know which direction the asset will move, right? It is uncorrelated. Sometimes if a portfolio goes up, that asset might go up, might stay the same, or might go down. There is no such specific clarity with regards to the past history that we can see. So that is the best source of diversification. But yeah, that's how the diversification and the whole impact will be kind of computed. So this is also true, vice versa. You can also do it for the portfolio with respect to a particular asset, and you can do it for that particular asset with respect to the whole portfolio. So yes, if okay, one important thing, if assets are long term, okay, assets are long term and liability is due, we have to realize asset. Realize in the sense, what does realize mean? Sell. Sell assets on poor term basis. This example, I had given it to you in the last lecture that, if you have invested all of your salary, your whole bank account, whatever it is, whatever amount you have, if you have invested in bonds, if you have invested in equities, okay, all your money is invested, you have blocked it, and now you have a credit card bill due. So now how would you, repay that? You will need to sell some of your equities, or not, bonds can be sold if it is not traded, but you need to sell some of your equities very quickly, and whatever value or proceeds that you get, you need to pay your credit card debt or your liability. So yes, if your investment, the term of the investment, okay, the term of investment, the term of assets should be, like, term of A should be equal to or close to term of liabilities. So in case of general insurance companies, when you see the assets that they invest in are very short term, they invest in treasury bills, they invest in commercial papers, they invest in zero coupon bonds, and all assets basically less than 1 year. So 90, 80, 90% of their investments are less than 1 year only in case of general insurance companies. However, if we look at something known as pension companies or insurance companies, their assets would be that average, duration, or the average term of their assets would be above 5 years for sure, because their liabilities are also very long term, right? So they might have invested in 20-year, 15-year bonds as well. They might have some short term instruments too, but generally very long term, mid term, a few short term. So on an average, the term would be above 5 years. And even for the liabilities, in case of insurance companies, the liabilities do arise after many years, right? So term of liabilities also would be high, above 5, 10, around 5, 10 years. The average, okay, average term of assets should be equal to the average term of liabilities. Now, if assets are short term, okay, so this was the example. The above one example was in case of a general insurance company. If you are a general insurance company, if liabilities are due, but you have invested all your assets into long-term bonds, long-term equities, properties, then in that case, it's not good strategy for you, and you will have to sell assets on whatever poor terms you are getting. Now, suppose here in this case, you are a life insurance company, and your liability is not due. Liability is 5 years, 10 years liability, but you are investing only in short term assets. So now what will happen is, suppose the liability is 5 years. Okay, liability is 5 years, but you have invested in a 6 month treasury bill, then probably after that another 1 year bond. So what you will need to do is, you will need to keep on reinvesting. Okay, keep on reinvesting on poor terms, because your one asset will keep on maturing, and then you have to invest on another asset. Automatically there will be poor terms, because what will happen is, if you have invested at time zero, okay, I'll just make a timeline. This is the timeline: 1 year, 2 year, 3 year, 4 year, and 5 year. If you have invested here you got 8%, okay, but year this got matured here, so probably here you might also get 9%, okay, that is the chance. But even that is 1 year, so here probably you got 7.5%, and maybe here you got 6%. So automatically, can you see, what you are doing is, rather than investing in a 5 year bond directly, you have invested in so many bonds where the rate of interest are different, right? Because you are investing in only short-term securities, and once that security matures, you get your money back. Then you find then you once you get your money back, it's not necessary that you will find another investment opportunity. Probably you'll have to wait a couple months as well, and after waiting, you found the opportunity, then you invested back, then again that got matured, again you got the money back. So there are lot of transaction costs also involved because you are buying, selling again and again. That does not make sense. You will need to pay taxes again and again as well. That will be another thing. And the rate of interest that you will get keep on varying. So what you need to do is, if your liability is 5 years, directly, uh, directly just take a 5 year bond, invest in a 5 year bond. Don't invest in 1 year bond, 6 months bond, 9 months bond. Invest directly in a 5 year bond, because if assets are short term and liabilities are long term, then you'll need to reinvest. All the reinvestment will happen generally on a poor terms only, so which is not good. We will move on. To currency. Okay, so mismatching by currency is also very risky. An overseas market would be considered cheap, okay, will be considered cheap if and only if expected return in local currency plus expected depreciation of home currency is greater than expected return in home currency. So again, what does this mean is, we will look at it properly. So if I'm considering INR, okay, if I'm considering INR and INR is depreciating, so what I'll do is I'll consider expected return in local currency. Here, local currency, let's just consider this as GBP or okay, USD INR only. So local, okay, local is USD because you are investing abroad. So for that abroad, you are investing overseas. So for that asset, the local currency is USD. So expected return of local currency, let's say in USD, you are earning 3% plus expected depreciation of home currency. Basically, INR depreciating. Okay, INR, suppose every year if it is depreciating by 5%, and if the expected return in your home currency, which is your INR bonds, okay, INR investments is 7.5%. If this is the case, then overseas markets would be considered very cheap and people will start investing in overseas market. This is what it is happening currently. Currently, when you look at USD, so US Fed, basically the Jeremy Powell, Federal Chairman, and US Fed, they are increasing their interest rates. The interest rate hikes have been very severe, and almost their interest rates are close to 0%, and now they are close to rough about 4%. Okay, USD interest rate on USD government bonds are 4%, which here assume we are considering all government bonds. Okay, nothing of private, because when we consider private corporate bonds, a lot of things come into picture like marketability, like the credit risk of that particular corporate. All those other factors might have different cases, and in that case, the yields might be different. Yields might be completely different. So we are not looking at corporate bonds as such. We are just looking at government bonds. So now the US government bonds are giving 4% interest, and everyone is investing in, because see, getting 4% is very high. Earlier, people used to get only 1%, 1.5%. Now the same people are getting 4% in US government bonds, which is the safest, right? According to theory, US bonds and US government is risk free, is officially risk free. They can default, but they haven't defaulted in all those years, and they are considered risk free because dollar is the global universal currency. So whatever happens, they won't default. They'll print more dollars to pay off their debt, right? That will lead to the fall of dollar value, but still they can always print that currency, because since their currency is the global currency, they can print it in any much amount. If we try to print INR, what will happen is the supply of INR would increase a lot, the demand would fall, the value of INR would fall and our exchange rate will shoot up from 80 to 100, right? And that will affect our country. But if it is in case of US dollars, it won't affect because US dollars is worldwide accepted. No matter what is the value of USD, whoever is demanding it, they'll still demand it, they'll still want it, and the transactions will be based in USD only. So USD is a US is a risk-free current country. So if the expected return is 4%, and now we have seen US dollars have appreciated against almost all currencies. When we look at INR, INR was 75. Now we have it has moved to around 83. So the expected depreciation of INR is around 8 to 9%. Okay. So expected depreciation is 8%. INR has depreciated 8% against US dollars. But if you look at other currencies like Euro GBP, they have depreciated more, but still INR has also depreciated. And this is greater than what Indian government gives, 7.5%, 7% roughly. So yeah, so if this is the case, this is significantly higher, then everyone will invest in USD, right? And this is what is the case now. The present reality is the same because USD is just strengthening against all currencies. Now this strengthening has reduced a bit. This 8% which I have mentioned, now it is reducing. Probably in the next year it won't be 8% again. It would be around 4, 5% or 6%. But still, if this interest rate continues, if this 4% in case of USD government bonds, if this continues, then what will happen is over the period of time, all the funds will flow out of India and they'll move to US. Okay, this is what is planning to happen, and that's why we are predicting a recession in the near term. The recession won't be so severe in India because Indian economy is already growing and it's at a much better stage compared to US. But still, there will be a recession in US and UK and rest of Europe and everywhere else. How much impact will it have in India? It's not still yet, measured as such, but still there would be. But this is how you can see why funds will move from INR to USD, मतलब India to US if this is the case. So that's why here in this example, overseas market is considered cheap and you may invest in. But if you are an Indian company, okay, if you are an Indian company, Indian insurance company, all your liabilities are denominated in INR, okay, then you are still investing all your assets in USD. So that's a bigger currency risk or a currency mismatch that you are taking. And what will happen is, if, sorry, sorry, I cut out in between. Hope currency is clear. I guess I explained over how overseas market can be cheap and you can invest. But there will be a currency mismatch risk because if you are an Indian insurance company, your liabilities are in INR, but you are investing in USD assets. Then you need to sell those USD assets, convert them back to INR, and pay off the INR liabilities, which might involve a lot of costs and a lot of risks as well. So yes, continuing with returns, in some cases, meeting liabilities is not critical, but getting maximum return is. Sorry. In case of policies like with profit insurance contracts, okay, if there are with profit insurance contracts, then in that case, getting maximum returns is critical. So you will invest in, you will try and invest and try and select in assets which provide you with the maximum returns. Even in case of unit trust, these are determined by their NAV, so net asset value. So they'll try to maximize the NAV and they'll try to maximize it by investing in high return assets. Liabilities under a money purchase pension plan, which are simply what the value of the fund turn out to be. So there are a lot of ULIP schemes, lot of other schemes where the fund value that you will receive at the end, the sum assured that you receive at the end would be the fund value, would be the pen, whatever the pen pot has been accumulated till date, that value would be the final amount. Okay, so in that case, you would want that amount to be as higher as possible. In this case, return is important rather than the liability because your liability is based on the level of return itself. This we'll look at it in chapter number 16 in much more detail. Some of the ways in which you can diversify within each asset class. So looking at domestic equity, you can diversify between different industry groupings and industry sector. You can check the level of overseas exposure, the size of company, level of growth versus income. So these are the ways. Size of company, I'll move growth versus income. Okay, so growth in the sense you will invest in smaller companies with a good potential of growth, or else you will invest in companies with very very high income. That means very very stable companies. So that is one choice. Level of gearing, you can invest in highly geared companies, low geared companies. What is gearing? It is your debt to equity ratio. The more the debt, the more risky the company is. So level of gearing will determine which company. It's basically you can diversify amongst differently geared companies. So that is another thing. Size of companies, you can invest in large caps, small caps, mid caps, all the type of companies you can invest in and diversify. Level of overseas exposure, you can invest overseas as well. And between broad industry groupings and industry sectors, there are so many sectors: IT sector, banking sector, oil and gas sector, then FMCG sector, consumer durables, so many other fertilizer, chemical, all those sectors. You can invest in those sectors and diversify. Looking at overseas equities, you can diversify by country, geographic region, or currency. That is simple to understand. By state and level of economy. So, is it a developing country, underdeveloped country, or developed country? So you can diversify based on that. Looking at property diversifications are by property type. There can be residential properties, office properties, shop properties. Then there can be factories, warehouses, so many other ways, so many other types of properties in which you can invest and diversify. You can diversify by location, region, and country. The more the prime location, we have seen this in chapter 9. Okay, so prime location properties, how they are classified: prime and non-prime. By type of tenant, who is buying it, who is renting it, if it is a company, is it a company, is it a group of individuals, is it one random individual, who are the tenants. Holdings and developments of the property. Is it a leasehold or a freehold? This also we saw it in chapter 9. Size of the property, direct and indirect investments is what you can do to diversify your property holdings. Fixed interest bonds, by type of borrower. Type of borrower, we know it could be NBFC, it could be a PSU, it could be a bank, it could be sovereign, it could be sovereign in the sense government, and last is it could be corporate. So these are the rough categories of type of borrowers, by type of duration, by currency, by marketability, by security, and credit rating. So these are some of the ways in which you can diversify your holdings within each asset classes. What are the risks of mismatching asset and liability? Now, if someone says that you are mismatching it in terms of, how can mismatch happen? First thing, you can mismatch it in terms of currency. That is one thing. I'll write currency. You can mismatch it in terms of term. Okay, term of the liability and term of the asset could be very different. The currency of the asset and currency of liabilities could be very different. And you can mismatch the cash flow timings. Cash flow timings. So cash flows of assets can be different, probably annual, but liability payments are quarterly. So that also can be a mismatch. So these are the examples of mismatching assets and liabilities. So there is a danger that when a liability outgo is due, assets have to be realized on a poor term to meet the outgo. We just saw this. If sudden liability arises and you don't have any free funds, you don't have any free assets, then in that case you have to sell your holdings, sell your investments to get the money on poor terms and meet that outgo. This is also known as liquidity risk. The value of assets of longer duration may be more volatile. So this is true. So if you are investing on a long-term basis, if you are investing in a 1 year bond compared to if you are investing in a 10-year bond, then the value of 10-year bond would be very volatile, right? It will keep on fluctuating a lot. Even with a small change in the interest rate, it will keep on changing a lot. So the more the volatility, that will affect your current market prices. So you would always want the volatility to be lesser in each scenario. But in case of long duration assets, the volatility will be generally very high, which you cannot avoid. There's a danger that this excess investment income and capital will be reinvested on a lesser good terms. So this happens in case the term of the assets is lesser than the term of the liabilities. So if the term of assets is less, okay, if the term of assets is 1 2 years on an average, but if the term of liabilities is 4 5 years on an average, then in that case, all assets will mature, all your holdings will mature, and you have to reinvest those. So that reinvestment will probably happen on poor terms, which you would not want it to happen, right? So that is reinvestment risk. This also we looked at it in the last slides. Um, you cannot match as you are likely to hold, not sure to hold what you are trying to match. So if you know if there is something like a general insurance company. So for general insurance company, like I mentioned, the frequency of claims is variable and the severity of claims is also variable, right? So since both of these are variable, in that case, what you can do is frequency and severity both being variable, the liabilities are uncertain. They can come at any time. Okay, timing is also variable. So within a year, at any given time, these liabilities can arise, and multiple liabilities can also arise, and the amount is also can keep on changing. So in this case, for general insurance companies, all these three things are kind of variable, which will make the liabilities much more uncertain. So the more the uncertain the liabilities, what you need to do is you need to invest in you don't know. First thing is that here it's mentioned you don't know what you are trying to match, right? You don't know whether these liabilities will increase with inflation or not. Yes, general the liabilities of general insurance will surely increase with inflation. So let's take an example of car insurance or something. So if a car accident happens, suppose a car accident happens, suppose it happens in 2010. So in that case, the cost incurred in garage, okay, for car repairing might be around 5 6 thousand INR, which is a little bit lesser. But now, if some same accident happens to probably the same car, now the cost of repairs and maintenance might have almost doubled in the last 10 years. So when we look at the claims as well for general insurance companies, may it be a fire insurance, may it be a normal car insurance or any other insurance, the claim value, the severity, since it is uncertain, the severity values will rise with inflation. So last year, whatever the severity that you got, this year they'll be a little bit higher because the expenses to repair and refurbish would have increased. But so again, the conclusion is you don't know what to match, and how do you match it? That too you don't know. And since in pensions, you know, right? Pensions and annuities, you know what to match. In case of in case of endowment assurances, you know what to match. In case of life insurance as well, you at least can predict the average age of the whole population. You can't predict average age of one person, but if you have 10,000 policies, you can predict using life tables that in any given year how many people will die. You have a rough estimate, like out of 10,000, if everyone is at age 21 and 10,000 people are there, then how many will die in 1 year? Almost zero or one, probably one or two, then 22, two or three, 23. Accordingly, you have a number, you have an estimate, right? Here, there is no such thing. Here you need to use past data, you need to consider distributions, you need to consider so many factors, but still it is uncertain. So what you will do is you will hold very marketable assets like government bonds and top quality assets, which you can sell it at any given time. Mainly, you can also hold cash. Cash is basically your bank balance account in your normal bank, and liquid assets with stable values. So all the assets that you will hold would be liquid. Basically, liquid assets in the sense can be sold and converted to cash very quickly. You can just sell it today, get the cash very quickly. So mainly it will be liquid and marketable assets with a tenor of with a very less tenor basically. So that includes only top quality investments. Uh, this happens in case of uncertain liabilities and mainly in case of general insurance companies. So now it's your responsibility to identify. In case of exam, they can come up with any random scenario of any random company. They can create a own company of their own as well. They'll mention it to you how uncertain the liabilities of that company are, and if they are uncertain, You need to tell them that hold many marketable assets only and hold liquid assets with stable values only. So we'll move on to the next part, which is the possible circumstances. So hope this is clear to you at this point. So possible circumstances, they include that no immediate need to realize assets in near future, no need to prove solvency on a market value basis, massive free assets, no pressure to produce consistent short-term performance, perfectly like a matched assets and liabilities, like in case of unitized funds. So funds where the liabilities are based on the level of assets that have been grown till that particular point. So if that's the case, then this is the possible circumstances, that this is the kind of the best circumstances as such that we might say. In this case, asset liability management risk would be very less. So here I just mentioned less mismatch. Oh, sorry. I just clear everything. Here I'll mention less mismatch risk. Okay. So in this case, there is a less risk, mismatch risk if there is no need to realize assets. If you don't need to prove solvency on a market value basis. So solvency on a market value basis is that using the market value approach to compute the valuation of all the assets and to prove solvency to the regulator. If there is no need, then you can invest in any kind of quoted, unquoted assets as such. If you have a massive free assets, so liabilities are 100 million, but you have assets of 200 million, then in that case, invest freely. No pressure to produce consistent short-term performance. It doesn't matter to you, then yeah, and perfectly matched. Then in that case, there is almost negligible mismatch risk. Hope you are clear with this. And with this, we are done with the section. Now we are just left with the last section about the individual's investment strategy. And with this, we'll be done with it. So I'll continue that in my last session. And thanks for watching this. If you have any doubts, feel free to reach out to me on the group. Thank you very much. Bye.